What's up, guys? This is Nick with Nick Does DGI, and welcome to my channel where I cover all things personal finance, stocks, and real estate. In this video, I go over whether you should pay off your student loans early or invest. My inspiration for this video came about earlier this year in March of 2020 when the US government passed a ginormous $2.2 trillion CARES Act in response to the economic fallout of the virus. Included in the bill was relief for all federal student loan debt, including a suspension of student loan payments, collections on defaulted loans, set interest rates to 0% until September 30th, 2020, and was recently extended for a third time until January 31st, 2021. And that deadline may be extended again if the upcoming Biden administration chooses to do so. I have many college and grad school friends who fall into the category mentioned above thanks to the CARES Act. They aren't legally required to pay off their student loan payments right now, so they have a nice large influx of monthly cash flow. They knew that I enjoyed personal finance and investing, so I was asked on several occasions throughout the year if that money would be better spent earmarked for additional student loan payments versus investing that into the market. So let's get into it. How do we get here? Student loans, two dreaded words among college students, parents, college grads, and grad school students. It's no secret that there is a huge student debt crisis in America. Student loans are now the second largest debt category in the United States, right behind mortgage debt and greater than auto and credit card debt. More than 45 million people, or more than 1 in 4 American adults, collectively hold over $1.6 trillion in student debt and growing. More than three-fourths of the borrowers owe less than $50,000, and the average student loan debt per new borrower is $37,172. And you can see from this graph what that $37,000 can get you these days: a down payment on a house, a brand new car, a wedding, swimming pool, or even startup costs for a business. And the average monthly student loan debt is about $400 a month and takes between 10 to 30 years to pay off. And the rate at which tuition has risen has been exponential, plain and simple. When you look at the dollar amounts, the average cost of tuition, fees, and housing for a four-year university in 1971 was $8,730 in today's currency adjusted for inflation. The same cost today is $21,370. In other words, a 145% increase, whereas the median household income has only increased 28% in the same time period. Anecdotally, I went to the same state public college as my father. He enrolled in 1980, whereas I enrolled in 2010. His in-state tuition cost $800 a year, or $2,526.50 adjusted for inflation today. My tuition, on the other hand, was $6,500 a year, or $7,757.13 adjusted for inflation today. 10 years later, a student in 2010, his or her tuition would be just under $10,000. And note, I have yet to factor in the cost of books, supplies, housing, food, transportation, and other expenses. As you can see, the cost has just skyrocketed. So now picture this. You're now in your mid-20s, gainfully employed, making a full-time salary. You have budgeted and found yourself with a nice extra sum of cash at the end of the month. You have the option to make additional payments on your student loans, or alternatively, put that cash into the stock market. And you ask yourself, which decision should you make? Because you want to make the right decision for yourself. The truth is, however, it really depends on your personal situation. Assuming you have a healthy emergency fund already in place, consider the following. First, interest rates. This is, in my opinion, the primary driver behind your decision making. The first step is to determine the rate of return you'll get from both investing or paying off your student loans. Student loans, whether federal or private, typically have interest rates between 3 to 7% depending on education and when it was accrued. But you can think of paying down student loans as a guaranteed rate of return. So for example, if your student loan interest rate is 4%, then you're getting a 4% rate of return by making that extra payment down. On the other hand, you need to determine a realistic rate of return if you were to invest it in the market or another investable security. In this day and age, bonds, certificate of deposits or CDs, and savings accounts yield practically nothing, but stocks will return on average 8% adjusted for inflation annually. There are about 2 more weeks left in 2020, but the S&P 500 is expected to return between 10 to 20%. So if the interest rates on your student loans are more than 8%, then it will be mathematically more advantageous to make additional student debt payments. However, if the interest rates do not exceed 8%, it is better to invest in the market. And as you can see from the picture, that historical 8% annual rate of return can drastically vary year to year. For example, the market dropped 47% in 1931, but at the same time returned over 52% in 1954. But they typically range from being down up to 10% and all the way being, rising up to 30 to 40%. And past performances is no guarantee of future results, but given time in the market, compounded year after year, you will generate more in returns versus your returns that you would get from paying down your student loans. The second thing to consider are the type of forgiveness programs available to you. But please note that this video only covers the basics of forgiveness programs. Please do your research. But if you have federal student loans and are eligible to qualify for student loan forgiveness, such as public service loan forgiveness, where some or all of your student loan debt will be canceled out at some point in the future if you are employed by the federal, state, or local government, or for a Section 501c4 nonprofit, then it doesn't make sense to make additional payments. If that's the case, you should invest that money into the market and let those investments grow. But please note that you might incur a tax bill with some repayment programs such as pay as you earn and income-based repayment, where you pay a portion of your student loans based on a predetermined cap on your income, because the IRS considers student loan amounts at the end of the program's taxable income. And lastly, there is more to life than student loans and investing. At some point, you may want to decide to get married, save for a down payment on a home, have kids, or have any other personal goals. And as mentioned in the beginning, an emergency fund needs to be in place before you can even have this discussion. Without an emergency fund, you are just one financial emergency away from the slippery slope of consumer debt and mounting interest rates. If you already have high interest debt, such as credit card balances or personal loans, pay these off immediately. No amount of returns from investments or student loan debt will make up for the credit card interest exceeding over 20% in many cases. And to wrap things up, I hope this helps shed some light to those in the position of whether to make additional student loan payments or to invest the money. But please note that this video is not intended as financial advice, and further due diligence is required. If you enjoyed the content, please consider subscribing to the channel and clicking the bell notification to receive all the latest video alerts. And don't forget to smash the like button. Take care.